Okay, it's June 2020, and yeah, the middle of the pandemic, and it's also an election year, and so just like a lot of people say, 2020, gotta love it. Dumpster fire. So in this presentation, though, I want to talk about kind of the state of the U.S. economy and trade, and in terms of trade, because it's an election year, and it's time for a lot of claims about the economy and basic campaigning nonsense. And so I like to look at the economy, look at how many jobs we've got, how manufacturing's doing, what the trade deficit is doing, just to kind of get a fact check of where we are so we can withstand the rhetoric. Okay, for most of these slides, and by the way, all of these slides here and all the data here are going to come out of the Federal Reserve Economic Database, or FRED. And this is a wonderful thing to use online. It's hosted by the St. Louis Fed, and it's a great resource. And first thing, jobs, right? When people talk about the economy, especially where it comes to international aspects and trade, jobs are the thing. And of course, economists always say, no, you engage in foreign trade in order to get the gains from trade, and that being able to buy things and have a better standard of living because you can buy more stuff cheap. That's the point of trade. But nobody cares, right? All they talk about are jobs. So let's start. So I'm gonna go with that, right? So U.S. employment. I got the time frame for everything here is going to be 1990 to the latest data the Fed has, which is first quarter of 2020. And what we see here, looking at this is all employees, total non-farm, which is basically what is used for employment. They don't count farm workers in there as part of that because they're families and it's hard to measure who's a worker. But this is generally taken to be employment, right? And what we see is in the 90s, we had a lot, pretty steady increase in the number of jobs in the country until we get to the recession in 2001. And you'll notice the shaded areas are the recessions, right? So there's in 91, there was the recession after the Gulf War that doomed the presidency of the first President Bush. And so that's on the left. There's moving left to right. You have a shaded area. Then around 2001, there's a narrow shaded area. That's another recession. And then in 2008 through 2009, we have what is known as the Great Recession, right? And that was mayhem. And as you can see, the Fed always shades these things because they always have a huge impact on numbers, right? And what we see is jobs increased nice and steady in the 90s. We had a little leveling off. We had stagnation. It actually rolled back a little, and jobs didn't increase for a couple of years, and then they started increasing. Then 2008, the number of jobs, nosedived. We lost. That's a close, it's those two lines that's in between, it just went from just below 140 million down to 130 million. So, huge job loss in the Great Recession. And then it, picked up and we had pretty steady increase in employment as, this is total jobs. This is not the unemployment rate, but, the unemployment rate went from 10% to like very low, like 2-3%. And so we see that from 2010 through basically the end of 2019, we had just a massive, pretty steady increase in jobs. And you'll notice at the end, the pandemic, wow, 20 million jobs, boom. And that's a guess right now. Those are all, but I assume it's an estimate that they refine these things, but I don't know if we want to talk too much about the pandemic. My point is that, when it comes to, and here's the first thing, I mean, you're going to hear a lot of claims. There's Obama versus the Trump era, and, when I look from 2010 to 2019, I see a line that's pretty steadily increasing throughout. And, This is one point I like to make, and a lot of people make it. We don't have presidencies, right, shaded here, right? The Fed doesn't see fit to mark presidencies on here because they don't matter. What matters is recessions, and presidencies often have very little impact on different performances, and so. We really, although recessions have a damn big impact on presidencies, as I mentioned at the beginning, this is one thing that I would say is kind of the common conventional wisdom, that, if you want to, they always say with economic policy, if you want to affect the economy, you get your picture taken with the president, but you talk to the chairman of the Fed. You sit down and have a meeting with the chairman of the Fed, because the president has very limited impact on things. They're generally riding the economy. And so I think here's a good example. Trump versus Obama era, we pretty much had a recovery that was consistent throughout each. Manufacturing. This is something that is a big, we got manufacturing, and how is manufacturing doing? And I got to tell you, for years I was preaching, manufacturing's fine, that we've had steady increases, right up till, because my data generally, when up to 2008, until that recession, if we look on the left, before 2008, the trend was always that manufacturing output was increasing, right? And here, this is, by the way, this is an index of real output adjusted for inflation. And an index, you pick an arbitrary year to make it 100, and this one, the output in 2012 is kind of normalized to 100, and so we have percentage points based on that. And basically, though, this is a picture of how manufacturing increased, and you see the output in the 90s. Manufacturing output increased 30%, and then it went up another 10% in 2000, after recession goes down, and then it came back another 10%. And the Great Recession, oh my God, it dropped big time, recovered, but notice that manufacturing output is still below where it was prior to 2008. Okay, so that is something that once upon a time my story was always, manufacturing is fine in the U.S., that we continue to increase our output, and that was true up to 2008. We've recovered, but you see that we basically, since the recovery, you have that V area where you have the bounce, and then it kind of meanders, right, and it takes a different shape. It's meandered basically from 2012 on. Not really, kind of going up, going down, and not really steadily climbing very much, just very slowly limping along with a flat spot from 2014 to 2018, and a little bit up, but then it's back down, and then this apparently doesn't have a big drop off. This does not apparently have pandemic data in it as well, but so we do see stagnant manufacturing in the United States, not a collapse of it. We still, it's not like we make less stuff, and we certainly, we're stagnant, we're low compared to our previous high, right? Which was way higher than the 90s. So, people complain about the 90s and 2000. We did have an increasing output. However, we've been a little bit stagnant now, and so that's something to worry about. Now, is that China? Well, that's a question. Later on, I'm going to show you some data that suggests maybe not, but it also, by the way, there is a feeling that manufacturing around the world, we just don't need that much manufactured stuff, and that manufacturing around the world is kind of slumping. There's just not that much demand for products, but it is something to keep an eye on. So American manufacturing hasn't been gutted. This is my thing. The idea that manufacturing went away is not true. It is, however, been stagnant for the past decade. So that's something for us to keep in mind. What has happened is employment in manufacturing has gone to hell, right? And you really do see it. I mean, 1990 to 2020, this range really gives us a lot, right? We start at what was the high, 18 million, right there in 1990. That was pretty much the high of manufacturing employment, 18 million people employed in manufacturing. And it kind of went down to 17 and kind of, wandered around between 17. In the 2000s, right, we get that recession and we hit 2000 and we have a massive layoff, right? I mean, my God, we go from over 17 million to just above in a couple years to just above 14 million, and so we're looking at a $3 million employee drop in manufacturing. And then that somewhat stabilizes, still continues a downward trajectory though, dropping below 14 million before the Great Recession. The Great Recession is like the Great Recession was a big, bat to the back of the head. And so we saw another 2 million over, a little over another 2 million people jobs lost in manufacturing till 2010. Since 2010, a slight recovery, about 1.5 million, maybe a little over 1 million. And again, along with jobs in the general jobs in the economy, it's been a pretty steady thing since 2010. It flattens out around 2016, and looks like 2015 to 2017. We have a flat spot in manufacturing employment, then it comes up a bit, and then it goes to hell as a result of the pandemic, but that's going to be very temporary. I don't want to worry too much about that. But the story here is manufacturing shed about 5 to 6 million jobs. And so even though manufacturing as an industry is strong because it keeps putting out a lot of stuff. And even though it was fairly stagnant since 2010, it did put back a few million jobs, but it's still it went from in 1990 an 18 million employee sector to today a 12 to 13 million, depending on where we're in that range. We're hard to say. We're about at 13 million before the pandemic came in, and the story here is generally that, hey, we have information technology, right? The big drop in employment that came about around the turn of the century was that just manufacturing shed a lot of jobs, and they automate. Factories, don't use a lot of people, and so that has been, and so the story up to 2008 was always, hey, look, we've had a big drop in people, but we still have a lot of production going on. That was driven, when you're taking people out, you're adding technology, right, to keep the output increasing. And so productivity through 2008, that was the big story, productivity growth in manufacturing, basically the mechanization of more and more processes, more and more machinery, and information technology. All these new things that we have were replacing people, and so you needed less people to make more stuff. And that was what was driving, both the growth of output and the drop of employment in the industry. Let's take a look at productivity now. And well, this is a change in productivity. So when the line is above, the blue line is above the horizontal black line, we see that productivity increases are going on. And what we notice is that through 2008, we were, between 2.5% and 7.5% productivity, kind of that 5% productivity growth looks about, if not average, in the middle. And so you were through that period having increases in productivity. Since 2010, well, I mean, the Great Recession, what happens? Productivity goes to hell. Why? Because manufacturers, went in a recession. You stop making stuff, right? Orders dry up, and you hang on to people. There's always I didn't talk about it, but unemployment or employment lags, right? The employment effects of a recession tend to lag behind it because companies hold on to their workers as long as they can, and then they have to shed them. And so what happens is you're holding on to your workers, but you're not producing much. So your output per worker, which is what manufacturing productivity is, goes into the dumpster. And then you fire everybody, and guess what? Or not everybody, and I won't be flippant about it, but when you fire a big chunk of your workforce, now you got less people, so your output per person goes up. And that's what that big swing is about. But we do see a rather disappointing productivity growth in the manufacturing industry. And that's probably, that probably tells us a story that we know the manufacturing, from the slides we just looked at, we know since 2010, manufacturing has put back a million or and a half jobs or so, million to 2 million. It was some number in there. So they did put a lot of people back to work after the Great Recession. But we know the output hasn't been really strong, and it's still been kind of anemic, and so you don't get a big increase in productivity there. And so we're seeing low productivity growth, which is problematic for the industry. And that is something that we want to keep an eye on and does worry us. But not, these things are not about foreign trade. These things are about economic conditions in the U.S. And that's pretty much one of the things that I always say is like, first always look to what's going on in the U.S. Foreign trade, it has an impact, but what drives it is, a recession, jobs, different situations. Speaking, all right, having said that, let's look at exports and imports. Here you've got U.S. exports and imports in absolute, in billions of dollars, and from 1990 on. And what you see is, exports are the red line, and imports are the red, and we definitely import more goods and services than we export. However, we also export a lot of stuff. And in fact, you see, it's interesting to look at this. Even though our manufacturing output was pretty stagnant since 2010, not really, if you recall, the output in manufacturing hadn't gotten bigger than the output in than the output prior to the Great Recession. It was actually still lower. Exports grew, right? And notice that by 2014, exports are, a good bit above where they peaked before the Great Recession, right? And they level off a little bit, and they've come back and grown a little bit since. But our exports, are fairly steady, and they were steady before the Trump administration. The growth was pretty steady. They've grown since then, although they had a flat spot at there. But again, the idea that, hey, it's not that, exports have grown because we got tough on our trading partners. What we see is exports were just growing in general, right? And they were doing pretty well. Yeah, imports, imports are still, and it's interesting, imports are a little bit higher, but they didn't go much higher than they were ahead of time. So in a lot of ways, our exports have been very strong. And throughout this, what kind of the story is, they go the same way. Yes, there's a gap, but exports grow at about the same rate that imports are growing. There's this lag, there's a gap there. And the explanation a lot of folks give for why is there a gap, it's because we're a net debtor as a nation, that we basically sell capital. And so we sell T-bills to foreign nationals, more than we buy. We're a net, what we call exporter of capital. And so we have T-bills, stocks, and bonds, right? Because a lot of people in our foreign countries want to buy U.S. stocks and bonds. So all that money flows into the U.S. Where do you think they get it? Well, they sell us stuff, right? And because we have the surplus in what's called the capital account, this is all the extra money that we get, people buying T-bills, and they buy more of our T-bills than they do other people's. Go figure. American T-bills are still kind of the gold standard for security. And we have a lot of companies that people want to invest in, and so there's a net inflow of capital, right, coming into the country, and therefore there's always, as long as that's the case, there's going to be a trade deficit, right? Because they got to get the dollars from somewhere, and they get the dollars to buy the T-bills and the stocks and bonds by selling us stuff. And so imports must exceed exports. It's a balance, right? And it's considered to be just, it's a natural balance. It has any difference between the capital account and the current account, right? The capital account includes the capital things I'm talking about, stocks, bonds. Current account includes exports and imports. They say any difference between the two is considered to be a statistical discrepancy because they have to balance. So that's part of the thing. But my big thing is I'd like to look at this and I say, our exports do pretty well and they've been pretty good. Now, we do have to say one thing there. One thing that may be impacting the 2012, 2014, somewhere in that period, the U.S., throughout that period, the U.S. is producing more and more oil, right? Once we had the Great Recession and we had the high prices of oil, the U.S. got really serious about oil and eventually became a net exporter of oil. And so for a long time, our imports were heavily, a big chunk of our imports was oil, right, that we had to import. And when we became a net exporter, that may have an impact on things. Not a huge one, but because it's it's a big economy. We're talking $2.5 trillion of we've got $2.5 trillion of exports and $3 trillion of imports, and it's a big, we're talking big numbers here. But what we've got here, we got to keep that in mind, that is something that may be in there. And again, it's not about presidents, and it's not about, it's more about the markets and economic conditions than anything else. Now, here's something I like to do. I like to, say, all right, let's look at exports and imports as a percentage of GDP, right? So here I had to take this data, and to get this graph, I had to get the data from the Fed and do my own graph here. And what we see is here are the red line is, imports as a percentage of GDP. The blue line is exports as a percentage of GDP. And the gray line at the bottom is the trade deficit as a percentage of GDP. And normally that's, the trade deficit's negative and would be below the zero line, but that I find that in comparing size to be irksome. And I guess my big point here is we've had, the exports as a percentage of GDP has gone up. It started out at 10%. It touched 12. It's down to 11, right? Imports maxed out at 18, and they're down a lot as a percentage of GDP. And the thing is, by scaling it to GDP, normally this stuff just is always going up, right? Here we're kind of saying, all right, let's compare it to, scale it to how much the total economy is. And it's when you do this that you notice, hey, look at that trade deficit number. It peaked at 6% in, what is that, 2004, 2006-ish time frame. And by 2013, it's down to just a little over 2%, and where it has stayed rock steady at just between like 2 to 3%. Yeah, it's right in there. It's between, but that's pretty flat, right? Hey, the trade deficit is 2 to 3% of our GDP, right? Don't tell me that means anything. This is the thing. It's like, if you look at the trade deficit in absolute terms, it's always getting bigger, right? Oh my God, record trade deficit. It's this many $billion. Oh, the sky's falling, right? I'm like, scale it to GDP. And guess what? Rather than going up, the story to 2006, 2008, if you looked at this before the Great Recession, you'd say, yeah, we've seen the trade deficit grow from under 2% to about 6%. And so it is getting bigger as a percentage of GDP. Since then, though, the Great Recession brought it down. And notice, the recessions bring the trade deficit down. Right? So don't tell me that trade deficits are, I mean, when things are bad, the trade deficit goes down. When things are good, it goes up. So, come on. The idea that the relationship is almost backwards, right? As people think, oh, trade deficit is terrible. Key thing, though, is the trade deficit is now and has been, and again, it's post Great Recession, right? It's not Trump, it's not Obama, it's post the Great Recession. We've been running at a very consistent 2% of GDP, 2.5 or 2 to 3%, right? And hey, is that a big deal? Right? How could that be a big deal? Right? If you look at the absolute number, it's very big and scary. When you look at a percentage of GDP, that's nothing, and it's shrunk since 2006. It's about half the size it used to be as a percentage of GDP, and it's kind of a trivial number. And so maybe we shouldn't be that worried about it, right? Here's the last thing. Right? This is the last slide, and I know half an hour of graphs. It's terrible. I always like this one too. I plotted the red and the blue line are, as like the graph a couple graphs ago when I plotted the absolute values of the imports and exports. And here we have the same thing, but we also, in this same graph, are plotting GDP. So now visually, our trade deficit and our imports and exports and the trade deficit, which is the white gap that is sometimes visible, right, between those lines. Now you're seeing it, right? And here it is. I really feel like looking at it this way gives you scale. It says, look, there's our total income. There's our exports and imports. And that sometimes visible white gap is the trade deficit that basically people who worry about imports and exports are talking about and worrying about. You can barely see the frickin' thing when you plot it with GDP. And also, you get a sense of just how much of the U.S. economy has nothing to do with trade, right? There's, trade is down there, and it's if you take the imports and exports, it's maybe 20% of the economy, which means that 80% of the economy, let's say 70, let's even, because it can get higher. 75% of the economy is about domestic production. We're not very open to foreign trade. And when you look at other countries, that export a lot, import and export a lot, as a percentage of their GDP, Germany's exports were something like 30% of its GDP, and its imports were, something like 25, 30. So that 70% of their economy, these are rough numbers, okay? But, 70% of the economy is about foreign trade and 30% is about domestic trade, right? That's being open to international trade. The United States is very insulated from it. And in fact, we're kind of in the ballpark of Japan in terms of how much foreign trade accounts for what size portion of our economy foreign trade accounts for. So worrying about foreign trade, you should be worried about it. It does have an impact. And things are good, but the trade deficit is not burying us. How could it? You can barely see it in this graph, right? I mean, whenever I show this to people, they're like, "Oh, this has got to be wrong." I'm like, "No, what's wrong about it? I'm showing you the data." Just no one does this for you. What they do is they tell you that absolute value of the line, right, in between, and it gets bigger and it gets smaller, but it's not a big, it's not a thing. It's not. I said it's not a thing. It's not scaled appropriately, right? And so we keep getting more and more. We keep getting bigger absolute trade deficits, but as a percentage of GDP, and here it's not. We're looking at the absolute numbers, but we're seeing it visually scaled to GDP. It's just not that big a deal. So this is my take. This is what I always say is that, hey, look, the American economy is largely about the American economy. The trade deficit isn't a big deal. Imports do grow. We have been, and in fact, imports have grown, even though our manufacturing output hasn't really grown very much. We are still selling more stuff overseas. So, okay, that may be that we sell a lot more because it's goods and services, but we're doing pretty well in that sense. Manufacturing has been stagnant. We have to say that's new. It used to have been for decades. It was very strong, and now, since the Great Recession, we've had stagnant manufacturing. That's an issue. Is that because of foreign trade? Well, how could it be if the exports have been growing, right? Our exports have been growing. So there's a question: what's going on? Why is it stagnant? We haven't seen productivity gains. Largely because increases in output have been through hiring more people, which is generally considered to be a good thing. But what's going on there? That's a question where you might want to dig deep and ask some serious questions. Probably blaming China is a bit simplistic, and this is something or foreign trade in general, because like I say, our exports have been doing fine. So it's hard to say that we're cheating, that people are not letting our products in. Something else must be going on. That's my take on it. That's the up-to-date thing. Those, do what you want with that, but I just want to offer it out to everybody in both my IPE class and in my survey of IR class. So I want to just throw these numbers out for you. So I hope you found them useful.